We are seeing some strange things happen in the bond market with a steeply inverted yield curve on one hand, while we also have negative real interest rates from the Federal Reserve. Meanwhile, they say they're trying to fight inflation, and you've got a whole camp of people saying you can't fight inflation with negative real interest rates. You have to get at least above the inflation rate before it has any effect. And so I'm going to show you today something that might be a little bit surprising, that you don't need positive real interest rates in order to combat inflation. And in fact, with negative real interest rates, you can actually cause deflation. Ready? Let's dive in. Real quick, there are just a few days left on my first week launch sale for my portfolio allocation course. If you are interested in learning how to bulletproof your portfolio so you're not vulnerable to large drawdowns during these crazy times, check out the link in the description below. All right, in order to get our bearings, we have to see where we are currently at. So let's take a look at a few numbers. Number one, let's look at the federal funds rate. We can see for decades, this number has been moving down to the point where right now we are currently at about 2.5%. And that is the upper limit of the range. Meanwhile, we have inflation hitting multi-decade highs. Last month in July, it hit 8.5% year over year. Despite the fact that inflation is so high, we are seeing the 30-year treasury with an interest rate of only 3.2%. The 20 years 3.4, 10 years at 2.9. The 2-year is at 3.2. So you can see 3.2 is higher than 2.9, and the inversion of the 10 and the 2 there is what is called an inverted yield curve, where you have the 2 higher than the 10. Going back to inflation, we have 8.5% inflation year over year. So it seems like some things are not adding up, because if inflation is higher than it's been in decades, we should see the people who are in charge of monetary policy, in charge of trying to fight inflation, raising their interest rates up to a point where they'd be at least equal to inflation. Otherwise, how are you going to combat it? But taking it one step further, even if the Federal Reserve hasn't raised their interest rates high enough, why in the world is the market setting the lending price to the United States government at a rate so much lower than inflation? Because every year you're losing money to purchasing power. You're losing purchasing power, I should say, to inflation. Because if you lost 8.5% of your purchasing power from July last year to July of this year, and you got paid 3% to lend money to the United States government, that means you lost 5% of your purchasing power. Not a good deal, right? Further than that, you would think that the yield curve would not be inverted here. Why is that? Well, take a look at a normal yield curve. So we've got the yield over here, so 1, 2, 3, 4, 5% up, and then maturity here, so 2 years, 10 years, 20 years, 30 years. In a normal environment, you would expect the interest rates would go up the further out the debt goes, because more risk is present with more time. That's why a 30-year mortgage has a higher interest rate than a 15-year mortgage. But the environment we're in right now is called an inverted yield curve, which means that the sooner maturity debt has a higher interest rate than the longer maturity debt. Given the fact that the Federal Reserve has interest rates at 2.5%, which is a long way away from the current inflation rate, you would expect that this would allow inflation to continue and persist for longer. And if your purchasing power is going to get eroded more and more every single year, you would want to request a higher interest rate on that long-term debt, not a lower one, right? Well, not so fast. So first, we have to understand what low interest rates do to the money supply. Take, for example, an extremely low interest rate environment that is also a low inflation environment like we had for quite a few years. In this environment, it's fairly easy to get your hands on new money. When it's easy to get your hands on new money, that's the same thing as saying the people who are giving the money are giving it away easier. There's a much lower bar associated with getting your hands on that money, which means that the likelihood that that money is being spent in a way that will not produce a positive real return is actually greater. And we can see this when we look at venture capitalist investments, when we look at tech projects, when we look at IPOs and SPACs and the altcoins that came out in 2017 and a bunch of different projects that started in easy money environments. Those have a destruction of wealth effect because those are bad projects that destroy wealth. They don't produce more wealth long term. They're running on investors' money, hoping they can capture a market and produce profits in the future. And then most of them inevitably do not. And so it destroys all the wealth that was invested in it. This is a deflationary force when wealth gets destroyed, not an inflationary one. So low interest rate environments where it's easier to get your hands on money at least have some forces built in that are deflationary. Now let's take another hypothetical example and let's take a look back at this inverted yield curve. So we know right here, let's just say at the beginning of the yield curve, this is the Fed funds rate. Right now it's sitting at 2.5%. But tomorrow, let's say the Federal Reserve decides to come out and jack this thing up to 7%. 7% still isn't as high as inflation, but it's a lot higher than we're at now. So if the Fed funds rate went up to 7%, what do you think the rest of the yield curve would do? Would it flip over here to look like a normal yield curve and the rest of the yield curve go up to 8, 9, 10, 11%? No, absolutely not. Why is that? Well, number one, it's the same reason why the yield curve is inverted right now, because the market believes the Fed will lower interest rates in the future because of economic pain. If we look at current rates, the market believes that in 2 years, interest rates will be a lot lower. And in 10 years, there's a much higher chance of interest rates being lower than there is in the next 2 years. This is due to the anticipation of the Federal Reserve intervening to bail out the markets in case of another deep recession and lowering interest rates. But that's not all. And to understand this next part, we have to look at the money supply. Because as I've pointed out recently, ever since December of 2021, the money supply has moved sideways. Despite the fact that interest rates have been below the inflation rate, we have not seen a growth in the money supply on average. It has stagnated and moved sideways. This is because any tightening and making it harder to get your hands on debt reduces lending, because lending requires both a lender and a borrower. And so if I, as the average household, have record high debts, which I do right now, or if I as a government have record high debts, which I do right now, or if I as a corporation have record high debts, which I do right now, that debt is at low interest rates. And so as interest rates move up even just a tad bit, it makes rolling over that debt more and more expensive, which means that more of my capital has to be allocated to just paying that debt. So as interest rates go up just a little bit, it has an offsetting effect on inflation because the money supply growth stops, because some capital has to be allocated to paying back that debt, or at least paying more just to service the debt. So even though the Fed funds rate and every other interest rate is nowhere near the inflation rate, we have seen it stall out the growth in the money supply, because money supply is lent into existence by banks, whether it's the central bank or whether it's regular banks. Money is lent into existence. And so if debt becomes too expensive for me to take out and continue to grow my debt, then I'm not going to be able to do that anymore. Just because it's more profitable for the lender to lend at those higher rates doesn't mean they're going to be able to lend it out if they have nobody to lend it to. So let's go back to our inverted yield curve and say the Fed jacks up interest rates to 7 or 8%. The immediate effect of that would be an instant just drying up of liquidity almost everywhere. Very few would be able to continue to roll over debt, and debt would start to get paid off. This would mean the money supply would start to plummet because, again, if money is lent into existence in circulation from those loans being created, then when those loans are paid off, you're sucking money out of circulation to go pay that money off, and then that money ceases to be in circulation, so the money supply drops. This would mean that an inverted yield curve would actually be very rational, because a very high interest rate at the short end of the curve would have an immediate deflationary effect on the economy. So I'm going to draw this for you to explain what I'm talking about here. Here is a steeply inverted yield curve, and here is inflation. So inflation is up here. So let's just say inflation is still above the short end of the curve. So inflation, let's say, is up at 9%, and the highest end of the curve at the short end is at 7%. You start to dry up liquidity right here and cause deflation to happen from a collapse in the money supply. Eventually, that results in prices dropping, and when prices drop, eventually you start to get deflation, so below the baseline of 0, which means that at the end of the curve here, 30 years out, you actually end up with positive rates, because by the time that 30 years comes around, we've already had a lot of deflation in between now and then. And so yes, this interest rate of the 30-year debt is way below the inflation levels that we're currently experiencing up here at 9%, but this debt doesn't mature for 30 years. And by the time it does mature, again, the inflation rate will have changed into a deflation rate, and you get a positive real return on that low interest debt. And so the reality is, just because you have long-term debt at interest rates lower than the current inflation rate doesn't mean that's all suppression, doesn't mean that's all manipulation. It certainly has something to do with it, but there's a rational approach to saying, hey, the higher short-term interest rates go, the more of a deflationary effect that has, which means that you don't need to command higher interest rates further out on the curve, because by the time that debt matures, you will have a positive rate long term when accounting for every single year. The key thing to remember about all of this is that it's all about the money supply. And all you have to do when there's a lot of debt in the system, all you have to do is dial up the interest rates just a little bit, and that puts a huge squeeze on servicing that debt. Because you've got a lot of debt, so it's cheap to pay that debt, those debt servicing costs at those low interest rates. But a little move in interest rates up makes that whole debt pile extremely expensive. And finally, I'm going to be in Spokane, Washington in just a few weeks, speaking at the Silver Symposium. So if you are in the area, I would love to see you there. I've got a link to sign up for tickets in the description below. As always, really appreciate you guys. Thank you so much for watching. Have a great day.